You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I have to tell you, I am on the hunt for a candidate for my portfolio. I'm looking to add a position, and I was going through the rockstar list, and one name caught my eye. Stantec, STN.to or STN on the New York Stock Exchange, so it trades on both market. So today we're going to do a quick 10-minute review of Stantec, see their business model, the growth potential. We're going to look at the numbers, and we're going to end up this episode talking about the risk because, of course, nothing is free, nothing is perfect, and even the companies showing a robust dividend triangle can have weaknesses. So what does Stantec does? Well, it's an engineering firm, and what's interesting about it is it covers all phases of project life cycle. So if a client needs anything about infrastructure, like if you needs to build an infrastructure, Stantec can help with the planning, the design, doing the construction and administration, the commissioning, the maintenance as well, the decommissioning, and the remediation. So you either have a brand new project or you have to get rid of a structure. Stantec is there every single step of the way. They operate under 5 business units, so infrastructure, water, buildings, environmental services, energy, and resources. So they are present in various industries. They're serving tons of clients. So that makes them a well-balanced, well-diversified engineering firm. And they also do business in Canada, in the US, and also offshore. So they're present a little bit more everywhere. So what's the narrative here? Like, what's the investment thesis? What makes Stantec interesting? Well, first, I like the fact that they have an integrated service. So that helps them to cover all cycles, but also since it's a cyclical type of business model, they can get contract at pretty any stage of the infrastructure, which is kind of interesting. They also benefit from many global trends such as the climate changing, demographics changing, and also the urbanization phase. So we see a lot of spending into infrastructure, the water services, environmental services as well, and they are serving all those industries. Another thing that I like is their top 25 clients only represent 15 to 20% of their revenue. So not too much, not heavily concentrated. They have a great portfolio of clients. And what is great is they've been doing services for those clients on an average of 20 years. So that's a statement right there of their quality. They're not just benefiting from like great trends at this point, but they have a great reputation where they can also attract more clients. More than 50% of the top 25 clients are actually dealing with 4 or 5 Stantec business units. So you can see here that the quality brings also cross-selling opportunities. So far we have an engineering firm that can service clients from the beginning till the end of their project. They surf on many global trends. Their top clients are long-term clients, been like also showing some stability and predictable income, and of course a lot of quality. They have cross-selling opportunities. They expect to grow organically by about 7% per year, which is pretty solid, high single-digit organic growth. And on top of that, well, Stantec is not shy to make acquisition either to boost their services, boost their portfolio of clients, and of course, as you can see the pattern here, whenever they make an acquisition, they will also benefit from their reputation to offer other services. Now, how does that translate into numbers? Because it's great to have a strong investment thesis. So the narrative so far, very exciting, right? You're already ready to press the buy button. But I mean, that's just one part of the story. Does this translate into a solid company? Well, with solid fundamentals? Well, it does, which is probably the best part, right? So the company shows more than 10 years of dividend increases. It increases dividend around 7 to 8% per year, show super low payout ratio. We're talking about under 25%. So that's, again, very solid. And they show a mid-single to high single-digit revenue growth rate, very solid earnings per share. So overall, a robust dividend triangle where revenue, earnings, and dividend increases greatly, especially since 2022. So there was a long phase of a plateau between 2017 to 2021. There was some growth, but not too much, both for revenue and earnings. The dividend was growing at that time nonetheless. And then boom, we got since 2022, more acquisition, more contract, higher backlog, and everything is pointing towards the summit. If you're looking for stock like this, they qualify as dividend rock stars, as I like to call them, because they have revenue, earnings, and dividend growth over the past 5 years. You can download the list that is being updated monthly at moosemarkets.com/rockstars. That's moosemarkets.com/rockstars. All right, so now I got you all excited about Stentech, STN.to. First, I'm not giving you financial advice here. I'm just highlighting some information and giving my opinion, but it doesn't necessarily mean that you should buy the stock. And of course, there's some risk, and we have to talk about those. First, even though it is a well-diversified business serving multiple industries and doing business in North America and outside of North America, it's still highly cyclical. So if you look at the dividend triangle trends over the past 5 and 10 years, you will notice that there are some down times. And that means that whenever the economy is slowing down, which could be the case in the coming years, well, they will get less contracts. So they're not going to crash and burn, but they may not be such a perfect company with robust dividend triangle. So that's the first thing. The second thing is, well, they just made an amazing run on the stock market. So the stock price just, we could say skyrocketed. In 22, the stock was trading around $60. Now it's getting close to 120. So within 2 years, it doubles in value. This is the type of returns I wish I had in my portfolio for all my stocks. Unfortunately, I do not have Stentech right now. So maybe they were a long time due now for a bit of a correction. The P/E ratio still is in line. So the forward P/E ratio is under their past 5 years average, which is kind of interesting. But yet, maybe it's like the easy money has been gone on this one and most of the growth potential has been priced in. So that could be definitely a risk. Another risk for this one, competition. Of course, when you're thinking about the big spending in infrastructure, there are a lot more than just one engineering firm. Just to name one that is well known and part of the TSX 60, WSP Global. So ticker WSP. This one doesn't increase its dividend, but shows similar metrics in terms of robust dividend triangle. Besides that, they use all their cash flow to generate more growth and more added value for shareholders instead of paying them back with a higher yield. So they do pay a dividend, but a very small one. The thing is, WSP Global is twice the size of Stentech in terms of revenue and also in terms of market capitalization. So with that kind of competition, you can expect that there will be a bidding war sometimes to get contracts. So a lot of pressure on pricing, which could squeeze margin, and Stentech may be the loser in those kind of fights since they are not the biggest player. Another thing that will come into play is how they can retain talent and attract new talents. Since they're not the biggest player in town, they may have a hard time or may have to pay talents even more than WSP Global. So again, putting some pressure on the ability to gain contract depending on the talent that you have inside your firm, and also the ability to generate better margin if you have to overpay people to keep them instead of seeing them fly away to another competitor. Finally, when you grow with mergers and acquisition, it's not always easy. There are a lot of risk related to the price you pay, the integration, the debt level you get. If you do the wrong acquisition at the wrong time and there's an economic slowdown right after, you take on a big chunk of debt to acquire a major player, that could go against you as well. So as you can see, while Stantec seems to be a very attractive candidate for a dividend growth portfolio, still not perfect. I will still have to weigh the pros and the cons. I'm not too sure if I'm going to add it to my portfolio. I know there's a power here. I know it's great, but yet I'm not 100% convinced. I have to think about it a little bit more. If you want to tell me more about Stantec and your opinion on it, well, you can go on the YouTube channel on Dividend Guy, and I have all my podcasts over there. So we can the advantage here is that you can put your comments, ask questions, and I'm reading all of those comments. All right, Moose, that's enough for today. Tomorrow it's Business Friday, and don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.